Energy shocks, higher yields, and an AI boom are pulling markets in different directions, and the balance between them is getting tighter by the day. Welcome to vTalkInsight, Allocator's Lens Daily for May 5th, 2026. Cross-asset positioning now hinges on how long strong earnings and AI-driven momentum can offset a tightening rates backdrop and a serious oil shock. So let us start with equities. In equities, indices are still close to their highs, even after a modest pullback and only a small uptick in volatility, which tells you how powerful the earnings and AI story remains. Yet beneath that calm surface, leadership is narrowing and the risk-reward no longer looks as asymmetric as it did earlier in the year. AI-related investment has become a key engine of the U.S. economy, contributing around 1.5 percentage points to roughly 2% recent GDP growth and even overtaking consumption as the main driver in some estimates. Hyperscalers have just reported roughly 25% revenue growth and around 60% earnings growth, crediting efficient AI deployment, and that is feeding through in a strong demand for chips, data centers, and industrial real estate across the U.S. and Asia. Corporate results broadly back up that macro story, with the median S&P 500 company delivering about a 6% earnings surprise, the strongest in 4 years, and median earnings per share growth near 16%. Index-level earnings expectations have been revised higher as well, from roughly 308 to 323, and investors are still penciling in double-digit growth, even with oil above $100 and heightened geopolitical risk. The challenge is that this earnings power is highly concentrated, with a handful of mega-cap technology names accounting for close to 60% of reported growth and less than 60% of S&P 500 constituents trading above their 200-day moving average. Many cyclical and rate-sensitive sectors are lagging, including consumer discretionary, parts of energy and materials, and European autos, which have sold off sharply on the mere threat of higher U.S. tariffs on imported cars. The energy shock is already visible in travel and leisure, where global airlines have cut around 2 million seats in the past 2 weeks on fuel availability concerns, and largely unhedged U.S. carriers face an 84% jump in jet fuel costs. Spirit Airlines bankruptcy and the blocked JetBlue merger highlight how quickly higher fuel prices and weak margins can morph into both equity and credit stress, with cruise lines also warning about disproportionate exposure to Middle East disruption. Flows and positioning paint a late-stage feel to the rally, with equity exchange-traded fund inflows since March exceeding $6 billion, more than double the pace seen earlier in the year, and portfolios reportedly overweight equities, especially in Europe and emerging markets, while underweight bonds. At the same time, hedge funds have delivered one of their largest tech de-risking episodes in a decade. Momentum strategies have turned net sellers of global equities, and overall positioning is approaching the bullishness seen in late January, even as big buyers like Berkshire Hathaway flag stretch valuations for new acquisitions. The common thread is that equity resilience is becoming more reliant on AI and affluent consumers, while many other areas of the economy and market have seen investment crowded out over the past 5 years. Commentary now suggests that upside from here looks more limited, while downside risks are rising if AI enthusiasm fades, if oil remains in triple digits, or if yields push through key thresholds, setting the stage for more two-way volatility rather than a one-way grind higher. For allocators, the equity focus in the weeks ahead is on whether strong AI earnings can keep offsetting higher energy costs, weaker breadth, and a more demanding valuation backdrop. That brings us directly to rates, because long-end yields are an increasingly important constraint on how far equity multiples can stretch. In rates, the story is a familiar but sharper one. Long-dated U.S. Treasury yields have pushed back toward the 5% area, and several desks now flag 4.5% on the 10-year and 5% on the long end as levels that could meaningfully pressure risk assets. That backdrop means equities are increasingly competing with risk-free yields that look attractive on an absolute basis. Recent data give the Federal Reserve little reason to ease quickly, with jobless claims near multi-decade lows, private payrolls, and other labor indicators showing no sign of weakening, and consumer spending still supported by larger tax refunds. At the same time, inflation has re-accelerated, with some estimates putting core inflation around 3.3%, while gasoline prices and triple-digit crude are broadening price pressures beyond energy into goods and services. Against that backdrop, several Fed officials are leaning harder into the message that inflation risks matter more than employment risks right now, and that there is little justification for imminent rate cuts. The base case being discussed is a prolonged pause, with any cut this year contingent on a clear easing of both geopolitical tensions and inflation pressures, and some officials signaling a move toward a more neutral or even mildly hawkish bias if oil shocks persist. There are also growing concerns around term premium and funding, with persistent fiscal deficits and heavy reliance on short-term Treasury issuance, raising the risk of a sharp shift in sentiment if investors demand more compensation for holding duration. Some commentary links higher yields to potential selling by foreign reserve managers in Asia and the Gulf as the dollar strengthens, even as strong domestic demand and hopes for AI-driven productivity gains help anchor real yields and keep U.S. inflation expectations contained relative to global peers. For portfolios, that mix means fixed income now offers much higher carry but less diversification than in the past, because yields can rise alongside risk assets when energy or geopolitical shocks dominate. It also explains why some allocators are leaning more on liquid alternatives such as commodities, gold, or catastrophe bonds as hedges, and why the interaction between rates and equities remains a central risk to watch. Credit markets, on the surface, still look benign, with spreads at historically tight levels even as economic and geopolitical risks build. Several observers argue that this suggests markets are underpricing the probability of future deterioration, especially if growth slows under the weight of higher energy costs and higher real yields. The more acute stress signals are in private credit, where retail inflows are slowing as liquidity concerns and recent challenges reinforce the view that many of these products are fundamentally institutional in nature. Upcoming quarterly redemption windows for semi-liquid vehicles could force asset sales if requests spike in late May or early June, and senior Fed officials have warned that psychological contagion from private credit stress could tighten financing conditions well beyond the direct exposures. Sector examples underline how quickly the cycle can turn, particularly in travel, where surging fuel costs and weak margins have already pushed Spirit Airlines into liquidation after a failed rescue, and left U.S. carriers facing profit pressure alongside potential route cuts and higher fares. Norwegian Cruise Line's earnings miss and guidance cut, partly blamed on Middle East conflict exposure, shows how an energy and geopolitical shock can feed into corporate cash flows and, ultimately, credit quality. Balancing that, some credit specialists still view diversified lending to a broad base of companies as resilient, arguing that isolated defaults need not define the asset class, and that long-duration, income-generating private assets remain underrepresented in retirement portfolios despite historically strong long-term returns. The surge in AI-driven capital expenditure is also creating sizable investment-grade opportunities in areas such as chip fabrication, power infrastructure, and defense, and in a higher volatility regime that may increase the relative appeal of senior positions high in the capital structure. Overall, the message is that traditional assumptions about credit as a simple safe haven are being challenged by more complex sector dynamics, capital structures, and liquidity profiles. For allocators, that puts a premium on understanding where spreads are genuinely compensating for energy, rates, and growth risks, and where tight pricing may leave little cushion if volatility picks up. In foreign exchange, attention remains firmly on the yen and the broader Asia-Pacific complex, where recent moves have been driven by both softer domestic inflation and bouts of official intervention. Japan's Ministry of Finance and the Bank of Japan do not appear fully aligned, and many argue that durable yen stabilization ultimately requires policy tightening rather than repeated operations in currency markets, keeping dollar-yen a key barometer of regional policy strain. On the dollar side, higher U.S. yields are increasingly being linked to concerns that some Asian and Gulf reserve managers may trim Treasury holdings as the currency appreciates, feeding to dollarization debates and nudging term premia higher. Even so, strong domestic demand for Treasuries and the view that AI-driven productivity gains will keep U.S. inflation relatively contained underpin confidence in the dollar, although today's thin liquidity, with several major markets on holiday, raises the risk that even modest headlines could trigger outsized currency swings. Commodities and energy in particular remain the macro hinge, with escalating tensions in the Strait of Hormuz pushing Brent crude above $110 a barrel and keeping investors laser focused on supply security. Reports of drone attacks on Western vessels, conflicting claims about strikes on U.S. warships, and Washington's pledge to assist stranded ships through air and electronic surveillance have all reinforced the sense of a fragile and highly politicized shipping environment. Physical crude markets are trading at notable premiums to paper benchmarks, reflecting persistent concern about near-term supply disruptions for prompt barrels and estimates of more than 1 billion barrels lost since the conflict began. Scenario work suggests that if a blockade around Hormuz were to persist through May, oil prices could rise by another $20, pushing U.S. benchmarks toward $110 and Brent toward $130, levels that would force a broader reassessment of global growth and inflation trajectories. Even at current levels, economists estimate that an average oil price around $100 this quarter could shave roughly 0.4 percentage points off GDP growth, while elevated refined product prices up 50 to 80% from pre-war levels, strain supply chains and corporate margins. Rising gasoline costs are already broadening inflation pressures beyond energy, with prices above $4 per gallon seen as a tipping point for changes in consumer behavior, weaker discretionary spending, and pressure on sectors tied to travel and commuting. The fallout is visible across industries, from global airlines cutting 2 million seats and reshuffling routes, to Gulf carriers adjusting networks, and U.S. airlines and cruise operators warning on earnings as fuel and geopolitical risks bite. Persistently high energy costs also risk feeding into food and services inflation, raising stagflation concerns, particularly for regions more dependent on imported energy and with less fiscal room to cushion shocks. Geopolitically, there are glimmers of potential de-escalation, such as Iran's proposal for a 14-point plan to end the conflict and reopen Hormuz, but most commentary expects continued attrition between Tehran and Washington, especially as China instructs refiners to ignore U.S. sanctions on Iranian oil and U.S.-Europe trade tensions resurface around auto tariffs. Longer term, a possible decision by the UAE to leave OPEC and ramp production to about 5 million barrels per day could boost supply and weigh on prices after the current crisis. But in the near term, many allocators are favoring diversified real asset exposures, including infrastructure and copper producers, as hedges against a combination of energy-driven inflation, geopolitical risk, and higher rates. Pulling it all together, the cross-asset picture remains a tug-of-war between powerful AI-driven earnings support for equities on one side and a tightening mix of higher long-end yields, an acute energy shock, and growing credit and geopolitical risks on the other. Equities are still riding strong profit growth and AI capex, but breadth is narrow and valuations increasingly need both stable rates and at least a cap on oil, while rates markets are signaling a higher for longer regime that limits the scope for multiple expansion. Credit spreads remain tight even as private credit and energy-exposed sectors show strain, and in currencies the yen and dollar are absorbing the pressure from policy divergence and reserve shifts, with thinner liquidity magnifying headline risk. Commodities, especially crude, are the swing factor. A sustained period of triple-digit prices would likely force a rethink of inflation, growth, and central bank paths across all assets. For allocators, that means close attention to the interaction between oil prices, long-end yields, credit spreads, and AI earnings will be critical in assessing how durable the current risk on regime really is. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.